if you're not doing a very huge type of capital gain, depreciation recapture of seven figures or above, more than likely you need to just implement what we talked at the top, which is the lazy 1031 exchange. Invest in good investments such as real estate, where you get normal passive losses to be able to offset that passive income. And over time, you're just going to have to go into more and more deals to get more passive income to be able to offset that. Now, there is another strategy out there, such as real estate professional status, which allows you to use these passive losses to offset that ordinary income that you may have, especially for those of you guys new to this type of investing and with big high paychecks and 1099s. Just going to have to be patient. And that lazy 1031 exchange is just going to have to evolve over time for you as you start to build up your passive activity losses. What if you're somebody out there who already has a lot of passive income from other investments and you just need to get more passive losses? Or if you or your spouse is implementing real estate professional status and using passive losses to offset ordinary income, and you've been burning up your passive losses, driving your adjusted gross income to $380,000 or even $200,000 and below. You're probably wondering, how do I get more passive losses? In a way, the real estate professional status strategy in combination with passive losses to drive down your ordinary and passive income down to whatever you want is like a bow and arrow, right? You to do some damage to go hunting, you need to have the bow and the arrows. Where in this analogy, the bow is like the real estate professional status, which again, you need to work with your CPA to get, which typically means you or your spouse cannot have a full-time day job, and you need to allocate at least 750 hours to active participation in your portfolio. But if your CPA is on board, you're able to implement this. Now you just need a whole bunch of arrows or passive activity losses to load up in your bowl, and you can go crazy and drive your income down to whatever you want. Now, if you're following me here, you're probably like, all right, say I do all this. How do I get more arrows? How do I get more passive losses? First off is like the organic normal going into deals where they're doing depreciations. We'll do cost segregations to squeeze out even more losses on the front end. But another way of doing this is specifically seeking out projects and deals that may have other Section 179 losses or equipment. Now, what we've done in the past, we've invested in different types of investments such as ATM funds. Essentially, you're investing in ATM machines, which is equipment. And from there, there's great bonus depreciation laws surrounding equipment. Now, this is very similar if you're familiar with buying one of those very heavy vehicles over 5,000, 6,000 pounds, like a truck, an SUV, and writing that thing off entirely in the first year. It's the same concept that we're talking about. Now, another idea that a lot of general contractors will do out there in the heavy machinery world is that they'll create pseudo rental equipment companies. So they might buy a lot of backhoes, loaders, other trucks, other heavy equipment, have it on their books, and then depreciate the asset, get a lot of 179 losses there, which is passive losses, and use that to feed into their bow and arrow strategy. This is very common. And there are deals out there that will invest in the equipment purchases to be able to pass those equipment losses or passive losses down to you. Now, hopefully that helps you get the wheels turning in your head. These assets out there, again, with good operators has always been very rare. And I've always had to go to the lengths of my network to vet good deals because I'm also looking for these losses myself. So if you're looking at a whole lot of capital gains, or you need maybe $500,000 losses, perhaps you invest $1 million in a real estate deal and you get losses that way, or you find an equipment deal where you're able to get the losses there. These are just a couple real world working solutions that we've seen in the past that is a little bit more practical way than going down the 1031 DST installment sale route.